In this video, I want to take on a role that's crucial to equity investors, and that is the broker. This video will just cover the very basics and will provide a platform for future videos which provide more detail. So with no more ado, where are brokers involved in the financial markets? Well, within equity markets, you've got basically two types of market. Primary markets, where securities are issued. That's where you find exciting phrases such as initial public offering, IPO, something I cover in a previous video. And the secondary market, which is where securities that have been issued are traded. Now, brokers are involved in advising institutional investors on both stages, but unfortunately, many people would say, really, you're only going to come across brokers most of the time in the context of the secondary market. That is, once securities have been issued by a company and are available for trading. So let's take a look specifically at what brokers are up to and why you need them. Now, brokers essentially provide a link between you as an investor, a retail investor, and the wider markets. And they operate in a number of different markets, whether it's equities, bonds, and so on. I'm going to focus on equity markets here. Now, why do you need someone to act as a sort of connector between you and the markets? Well, the answer is, in theory, you don't. I mean, if you want to sell 1,000 Tesco shares, you can find yourself a buyer who wants exactly that number of shares. You're both prepared to agree a price you think is reasonable. You then know how to re-register shares from the seller to the buyer, because like property, shares are registered securities, and you don't think that your counterparty is going to default anywhere in the middle. They're good for the money and so on, and you can agree settlement terms, as it's called. Fine, go for it. But for most people, all of that trouble can be taken away by simply paying a broker. Now, it's not a free service. You will be paying a commission. I'll look at that in just a moment. But nonetheless, it's a lot quicker and simpler to use a broker. So with that in mind, how many types are there? Well, I'd identify essentially three types. First of all, you've got the XO, or execution only style of broker. Now, that does what it says on the tin. A little bit cheaper than the other types of broker, but then all you're getting is execution only. So you give an instruction to the broker, either electronically or by phone. All they do, they're not allowed to advise you on the wisdom of the trade. All they do is execute it for you. So you wouldn't expect to pay too much for that. Moving on towards what's sometimes called full service broking, you've got advice and execution. Now, as an investor, you may have some quite strong opinions about where you want to invest. You may have ideas about how you want your portfolio to look at the end of it. But the broker's there to help you out, offer advice, offer tips, maybe realign your portfolio, that kind of thing, to make sure you're properly diversified and not just kind of throwing darts at a dartboard when it comes to investing. All right, and then at the right-hand side, you've got full-blown discretionary management. This is people who say, actually, I don't want to be involved in day-to-day investing, but I do want a properly diversified portfolio. You look after my money for me. And that can be done either inside a tax wrapper, such as an ISA or a SIP, or outside of it. But essentially, the broker has control over the funds and the way they're invested. Okay? And naturally enough, if you're going for advisory stroke discretionary, you would expect to pay more because, frankly, you're getting more. Okay, so moving on to how trades get done. So I said the broker is a kind of middleman or an agent in the market. Very quick look at, from a retail client's point of view, how instructions get dealt. So there's you, a client. You contact a broker. You've decided that's the quickest, fastest, easiest way to get a deal done, and you've chosen your broker. Okay? Now, you're looking to sell Tesco shares, for argument's sake. There are two basic order types that you might use. There are more, but two basic order types. There's the market and the limit. So a bit of flexibility here. That says limit, by the way. You could say to the broker, I want to sell 1,000 Tesco shares right now, in which case the broker will try and get the best price they can, i.e. the highest price for your selling, or you can specify a limit order. You can say, sell me 500 Tesco shares for no less than. So if you're prepared to wait, a little bit of patience can be rewarded. That style of order could hold your order back, but may mean that you achieve the price that you want. So just bear that in mind. Now, how's the broker going to execute the trade? Well, frankly, this is going on behind the scenes, so I'll keep this brief, but there are two basic ways of getting a deal done. There is what's called electronic execution. So there are electronic order books, anonymous order books, where orders come into a central order book to buy and sell shares. The broker can see those, see who's trying to buy at the highest price, who's trying to sell at the lowest price, and match you with the corresponding order. Now that works silently, electronically, anonymously for popular, easy deals, if you like, in well-known shares, where a client wants to do something a little bit more awkward. So for example, where you're looking to deal an awkward number, an unusual number of shares, or the share itself is relatively illiquid, then some of the full service brokers can offer you the ability for them to contact market makers on your behalf, negotiate a deal that often involves picking up the phone and get you the best price that they can. But the broker will exercise a certain amount of discretion, if you like, in terms of, is it better to go down the electronic execution route? Quite a few cases it will be. Is it better to try and work the order through a market maker? And market makers are simply institutions that operate within financial markets and exist to make sure there is liquidity, i.e. the ability to trade in a wide number of stocks. So there it is, more detail about that in future videos, but a snapshot of how trades get done. Now, a lot of people think all a broker's doing for me is a deal. No, there's more to it than that. So when you're looking at commission, bear in mind that commission covers quite a few different activities, and I'll finish the video by covering those in just a moment. As for commission, there are a couple of ways it can be charged. Fixed price, percentage of deal are two common ones, or a mixture of the two. So fixed price is, for argument's sake, $9.99 per trade, and don't forget you'll pay it to buy and to sell on the way in and the way out, as they put it. Percentage of deal value is what it sounds like, okay, or it may be a combination of the two. Some brokers will say, well, it's a percentage, we're going to charge you a percentage of the value of the trade, subject to a minimum fixed charge. So always worth finding out how that works. That is designed to cover quite a few different things. Going into the market, using those electronic order books, contacting market makers, the broker themselves suffer what's called a bid to offer spread. That is to say that market makers, for example, operate like car dealers. They buy low and sell high. So the price that the broker can get for you and contacting a market maker does depend whether the broker's trying to buy or sell at the time. All right, so the broker's got to recover that bid to offer spread. And then there are administration costs, which I want to just cover in a moment, some rather grand language, clearing and trade settlement. So what's all that about? Well, essentially, the bit I've described so far is just getting a deal done. A deal is simply agreeing how many shares are going to be bought or sold and the price. But there's more to a transaction than that. It's a bit like property. There's more to just turning up and saying, I'm prepared to pay this amount for your house. There's quite a lot of other stuff that has to go on afterwards. Fortunately, in the equity market, it doesn't take quite as long as it does. With a property transaction, you'll be glad to know. But what is that other stuff? Well, there's clearing and there's settlement. Now, settlement, settling a share trade, in simple terms, is the buyer handing over the relevant cash and the seller handing over the relevant shares. All right, which usually happens simultaneously, 3 working days. Hence, you might come across that with a jargon T+3, typically 3 working days after the terms of the deal have been agreed. For those people who are interested, there's a proposal to move that to 2 working days. All right, but it's certainly quicker than buying or selling property, for example, as most of you will know. So there is a gap between a deal being done and the cash moving from buyer to seller and the shares moving, being re-registered from seller to buyer. Okay, so bear that in mind. And in the middle, it's just possible that somebody could renege on their side of the bargain. So clearing, I'm going to describe as the process of just making sure that nothing goes wrong, that everyone honours their obligations. Okay, just out of interest, it is possible through a broker to organise a quicker settlement for people, for example, who need the money quickly, and also it's possible to organise later than standard settlement, where, for example, someone's struggling to come up with cash in the right currency, but the standard is T+3. So just bear in mind that when you pay a broker that commission, it is designed to cover getting the deal done, clearing and settlement. All right. So in a nutshell, brokers do quite a few things on your behalf for the commission that they receive. There are different service levels available, and to some extent you get what you pay for in this market, and hopefully I've given you a platform in this video for future videos that will expand on some of those key basic ideas.